What's the best chance the average investor has to grow their wealth in 2024? Is it stocks, real estate, gold? We'll discuss all that and more coming up next. Hello and welcome to Finance Today, your golden pocket of financial facts and trends. I'm Phil Cogliato, and whether you're into real estate, commodities, stocks, the debt market, or crypto, we cover it all here with some alpha that the mainstream media doesn't want you to know. Quick disclaimer, I'm not a financial advisor and this is not financial advice. This is for your entertainment while hopefully adding some value. So if you're new to the channel, be sure to click that like and subscribe button. Turn on those bell notifications so you get updated with all of our latest content. With that being said, let's begin. So what is the best way to grow our wealth as an average investor in 2024? Well, in order to do that, we have to identify what's called an asymmetric trade. To find these asymmetric trades, you have to analyze an asset's risk to reward ratio. This means identifying the potential risk an investment has versus the potential reward. So how do we do that? In the simplest terms possible, an asymmetric trade is when the downside is limited but the upside is unlimited. Meaning, if I had 10 grand to invest and I lost it all in a bad investment before I cut my losses, I not only lost my initial investment, but I also lost the earning potential that $10,000 could have made me if I was, say, in cash, a dividend-paying stock, real estate, short-term treasury, or something explosive and volatile like tech stocks and crypto that has the potential to earn you 1,000% gain in a short period of time or lose it all. That's what I mean when I say the downside is limited, but the upside is unlimited. These are the kind of trades that have the chance to change your life for the better, but also for the worse if you're not careful. To identify an asset's reward potential, you can look at its current standing measured against its historic value. What part of this asset's life cycle are we currently in? Where are we in terms of, is this the right time to put my money in? Assets are cyclical, and in a typical cycle, an asset has four main phases that'll help you determine whether it's overvalued, fairly valued, or undervalued. These main phases are the accumulation phase, the markup phase, or as I like to call it, the blasting off to the moon phase, the distribution phase, and the downtrend. If you're familiar with trading, you've seen this chart before. This is the market psychology chart. That shows you where an underlying asset's price action has been and where it's potentially going based on historical data. Every time an asset has a parabolic run, you can be sure that it will be followed by a parabolic drop. It's not a question of if, it's a matter of when. So, if we knew when an asset would hit certain price targets, we'd all be trillionaires. So we have to look at this data to make sure we know where we're going. Just like the Fibonacci golden ratio that we've based the logo of this show around, everything always progresses or regresses to its mean, or phi. As you can see from the chart, the asset starts in the disbelief phase, which typically happens after an asset has crashed. This is where an investor would be thinking things like, oh, I can't believe this happened to me, man. Why was I so dumb to hold this back? Someone else is getting rich. I don't know what to do. And that would be the best time to be averaging into this asset, which is usually followed by the hope phase, which is where they would start to think something like, you know, there's a chance this could start climbing back up. I got a good feeling about this. Then you start to believe in the belief phase. Okay, this is real. I've made up for most of my losses. I think this baby's about to run. After that, we have the thrill and euphoria phase, which is, oh my God, I'm a genius. No one on earth is smarter than me. I am a golden god. This run's never going to end. All mortals kneel before Zod. Unfortunately, nothing ever lasts forever, and we enter the first drop, which is called complacency. I think it's going to go back up. I've made a lot of money. I'm going to hold it. I think it's going to go past all-time highs. I'm just going to weather this storm, you know? Then after that, we have anxiety, denial, and panic. Oh my God, this thing just dumped all over my face. I have no idea what to do. I can't sell at a loss, or can I? And that just leads to anger and ultimately depression. Remember what Yoda said. Fear leads to anger. Anger leads to hate. And hate leads to suffering. No one wants you to suffer. I don't want to see you suffer. I want to see you succeed. That's why we have this show right here, which is why I'm here to tell you what I've been buying hand over fist in 2023 and what I'm buying in anticipation of Q2 2024 and beyond. Have you heard of Bitcoin and cryptocurrency? And do you understand its value proposition? I could already hear you. Oh, Phil, don't shill me your crypto crap. This is fake. It's going to zero. It's all a Ponzi scheme. I thought you were going to talk about something real. Well, temporary disgruntled viewer, I'm here to tell you that it doesn't get any more real for me than this growing asset class. Why, you ask? Well, let's take a look at the debt market. The debt market is the driving force of all markets and what everyone should always be looking at when analyzing a trade or an investment. And it's a $34 trillion ticking time bomb. At the time of this recording, the DXY is 103.96. The 10-year treasury is 4.024%, which is still lower than the 2-year treasury, which is 4.372%. That's what you call an inverted yield curve. And what does that mean? If you let someone borrow your money for 10 years, wouldn't you expect to get a better return than if that same person borrowed your money for 2 years? Of course you would. And that's what you'd expect to see in a healthy economy, but that's simply not the case. The US is currently paying north of $1 trillion to service the yearly debt, and climbing. This number will only continue to grow by design of the debt-based system, and there is virtually 0% chance the US will be able to sustain this current path without a default or a revaluation. The US debt to GDP ratio surpassed 123% in 2023, and it's projected to get much, much worse. So eventually we're headed for a debt market implosion, the likes of which the world has never seen, and it's gonna tank every market when that time comes. No asset class will be safe. But it's not all doom and gloom yet, because in 2024, there are geopolitical factors that should keep that hard landing at bay. We have our presidential election cycle, which has always been historically good for the markets. Why? No one wants to vote for a president that doesn't help their 401ks grow. Am I right? On top of that, there are 33 seats in the Senate up for re-election, and there are over 50 countries worldwide that are heading to the polls in their respective countries. This is all extremely bullish for the markets. And Bitcoin and crypto assets are certainly a global market. Another huge tailwind is that the Federal Reserve is being forced to pivot off of their higher for longer rate mantra. The Fed said it has no reason to lower rates in March, and honestly, the longer we can keep purchasing cheap assets, the better in my opinion, but they will eventually have to pivot in 2024. You see, a lot of banks negotiated their debt during the ZIRP era, or zero interest rate policy era. The cost of capital was basically free, and traders, investors, and yes, lenders, banks, and yes, the US government negotiated lending and borrowing rates much lower than the current federal funds rate at 5.25%. Now, all of this debt will be needed to be renegotiated when it reaches maturity in 2025 and 2026, but at multiples higher than where it is now. The rub is that the banks have debt on their balance sheets with huge unrealized losses. And as we saw with Silvergate Bank and Silicon Valley Bank back in 2023, the dominoes are starting to fall, and JP Morgan coming in to vacuum up all those pieces at fire sale value. Yum, 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 yum. The cracks are getting bigger in the banking system, and just like in 2008, the only way to stop it is for the Federal Reserve to stop shrinking their balance sheet and add liquidity into the system. This means the Fed will have to cut interest rates while inflation is still way above their target of 2%, and inject liquidity in the form of quantitative easing. Basically, they have to turn on the money printer. This is going to cause our currency debasement to get even worse than it did in 2020. And remember how bad the inflation got then and never came back down, even though everyone and their mother told you, oh, it's transitory, it's not going to last. The dollar has already lost 99% of its purchasing power since its inception. What happens when it actually goes to zero? People think Bitcoin is a Ponzi scheme, but actually, the debt-based US dollar is the biggest Ponzi scheme in the history of mankind. A fiat currency with no hard money backing, where bankers can bend and change any monetary rule that they want because there's nothing in place to keep them honest, is a rigged system. You worked hard for your dollars, and you spend so much time working for them. Time. The most valuable commodity that we have. But as you earn those dollars, your central bank is devaluing the currency right in front of your eyes, making a dollar act like an ice cube melting in the hot sun, until eventually the dollar's purchasing power becomes just an echo of what it once was. And if you think that the dollar is bad, take a look at currencies like the Turkish lira, which is currently suffering from a 64.8 rate of inflation year over year. It seems like all fiat currencies are going the way of the Venezuelan bolivar and the Zimbabwe dollar, right into hyperinflation. It doesn't seem like a very sound system to store your monetary value, does it? The cool thing about Bitcoin is that out of control inflation simply isn't in the cards because it's hard capped with a supply of 21 million Bitcoins, meaning there won't ever be more than 21 million Bitcoins ever mined, whereas there can be an infinite number of dollars created. This makes Bitcoin an extremely hard form of money, and some may say the hardest form of money the world has ever seen. Similar to the gold standard, bankers can't fund endless wars when their system is tied to a hard form of money. With hard money comes hard rules. They have to play by those rules without the ability to spoof the market based on derivatives and base money inflation. Countries have taken notice that Russia was booted from the SWIFT system at the start of the Russia-Ukraine war in 2022. And Russian oligarchs had their assets seized in the United States. Believe it or not, most countries were justifiably upset by this action and have been looking for a way to transfer value over long distances without the fear of being ousted from the SWIFT banking system. You see, currently, there's a need for a dollar hegemony in what Brent Johnson calls the dollar milkshake theory, which is based on the global dependence of the US dollar for pricing and the long-term debt cycle. But Saudi Arabia has joined the BRICS, Russia is kicked out of the SWIFT system, China is settling trades in yuan, and the US has become entangled in yet another conflict in the Middle East. It seems like it's death by 1,000 cuts for the dollar. And it's very slowly but surely losing its dominance on the world economic stage. Where will the countries pivot? Well, they're already pivoting to their local currencies, gold, and even some have turned to Bitcoin. Countries realize that Bitcoin is permissionless, verifiable, easily divisible into 100 million Satoshis, as portable as it gets, durable, and has that hard cap of 21 million as we discussed, making Bitcoin a desirable asset to store wealth in for the long run. Yes, Bitcoin is much slower than many current blockchains, but what it lacks in speed, it gains in security, as its decentralization acts as a safe haven where no single entity can rewrite the rules without owning more than 51% of the total supply. Now that you have that little tidbit of information, this is where it gets really interesting. Let's talk about where Bitcoin currently is in its cycle. If we take a look at the entire history of Bitcoin and see where it is in its asset cycle and match that to the market psychology chart, we can see that Bitcoin and cryptocurrencies are in the accumulation stage and just starting to enter the belief phase. So this data is showing me that Bitcoin is very, very undervalued. Why is that? Let's talk about something that's happened every 4 years since 2012. Enter the Bitcoin halving. This is when the rewards for mining Bitcoin are cut in half and thusly cutting the potential circulating supply of Bitcoin as well. The supply shock is the start of Bitcoin's historic parabolic runs. This is the official historic cue for the bull market to begin. This not only sends Bitcoin price to the moon, but there's a discernible alpha that can be had with the altcoins. Typically, non-Bitcoin crypto tokens such as Ethereum, Cardano, Solana, and many, many others outperform Bitcoin during the bull run. However, you have to be careful because if you thought Bitcoin was volatile, you haven't seen anything until you look at some of the altcoins. I'm sure you've heard of Dogecoin's parabolic run from 2020 to 2021, but what we don't talk about is that altcoins typically lose 90 to 95% of their market cap in depths of the bear market. Some actually lose 100% and never fully recover. That's what that 100% downside risk I was speaking about earlier is. Bitcoin only loses around 80% usually. It's still very significant, but more and more liquidity is feeding into Bitcoin and the blue chip altcoins, which will ultimately make the assets more stable and those drops will be lessened over time. Fortunately for Bitcoin holders, one of the biggest events in Bitcoin's history just took place on January 10th, 2024, which is the long-awaited approval of the Bitcoin ETF. Yes! After years of battling with the SEC, asset managers like BlackRock, Fidelity, and Merrill Lynch can now give access to their clients to purchase Bitcoin via an exchange-traded fund. Why is this big? Because these managers control trillions of dollars. Even if a small percentage of that wealth enters into Bitcoin, it'll catapult the price and add stability for the years to come. Mix that with nation states like El Salvador making Bitcoin legal tender, MicroStrategy's Michael Saylor explaining to big-time CFOs how to profit off of putting Bitcoin on their ledgers to grow their wealth forever. It's basically a perfect storm of the most bullish bull market case in the history of cryptocurrency. And if you haven't been paying attention, it's been pretty bullish already. There are rumors that Ethereum also will eventually have an ETF launched at some point in 2024, and if that happens, there may even be other altcoins to follow. Regardless of that speculation, altcoins are primed to simply explode in 2024 due to inflation, which is, as we discussed, currency debasement. And this makes an asset class that offers permissionless cross-border transfer, the ability to grow wealth using DeFi applications, highly desirable for people who lack access to that traditional banking system. And that's many, many people around the globe. Okay, that's a lot of information to unpack, and I'll let that sink in for a moment. So to sum it up, yes, there is a bull case to be made for the stock market, gold, and commodities, and I fully expect those assets to perform very well this year, especially growth stocks like big tech pushing AI, graphics cards, and robotics. But I think they will all pale in comparison to the most explosive asset class of all time this year, which is Bitcoin and cryptocurrency. There really are so many catalysts coming up in 2024, and I feel like I'm not even bullish enough. Remember, crypto is extremely volatile, and it's not for the faint of heart. Be prepared to struggle with regular 35% drops after you see some decent gains. It's all part of the game, and you have to be prepared for it. Altcoins in particular, you can lose your entire investment to a rug pull, malicious smart contract signature, or straight up scammer. You really need to sit down and spend some hours researching the industry and wrap your head around the pitfalls before investing. Don't just listen to some guy on the internet or your friends. You really need to do your own research, and you need to own all of your successes and all of your failures. The best strategy I've found to be successful has been what's known as dollar cost averaging, or DCA for short. This means I put a set amount of capital into these assets regularly, regardless of the price, and I pull capital out once they hit various price targets, effectively taking profits. The key is don't be greedy. Bulls make money, bears make money, but pigs get slaughtered. And yes, past success does not guarantee future results, and history does not repeat itself, but it sure rhymes, doesn't it? I'm expecting Bitcoin to reach a price target somewhere between 150 and 350,000 US dollars in 2025, depending on how ridiculous this bull run actually gets. And it seems like it's going to be pretty crazy. Even though Bitcoin has the best historic ROI of any asset class ever created, its dominance has been falling to altcoins over the past 2 cycles. You can see that the altcoin total market cap has not only been steadily growing with Bitcoin, but it's been massively outperforming it during the bull runs for quite some time. However, the bigger the rise, the bigger the fall, and altcoins do usually dump 90 to 100% of their market cap during bear markets, and some never recover at all. But with that said, I'm still expecting blue chip tokens like Cardano, Solana, and Chainlink to have a 5 to 10x left in this bull cycle, and smaller L2s like Cody maybe even still have a 10 to 20x left. And some small meme coins, especially Cardano native tokens, to make even greater returns. We'll make another video about that shortly. But the higher the potential reward, the lower the market cap of that crypto asset has to be. So expect extreme price swings in all of these coins, but especially in the low cap alts, because like we discussed, it takes less capital to move the prices of those assets. With less than 50 days to the Bitcoin halving on April 20th, these are still bargain prices, and they're not going to last, as investors all over the world are waking up to the value of Bitcoin and hard-capped cryptocurrency. This is definitely a time-sensitive situation. Don't take my word for it. Put some time in and research everything we've discussed here for yourself. The easiest ways to purchase these assets are through a centralized exchange like Coinbase, but many blockchains utilize DEXs, or decentralized exchanges, which are more for the tech-savvy user. Once you purchase your crypto assets, make sure you take them off the exchange as soon as possible and store them in a cold wallet until you're ready to part with them. There's a saying that we have in crypto: not yo keys, not yo crypto. The poor individuals who kept their crypto on Celsius, FTX, and BlockFi can tell you that firsthand, unfortunately. With that said, I hope you found value in this video. If you did, click that like button and share the video with a friend. Maybe drop a comment and let me know what you thought added value or what you'd like to hear about next. If you didn't like the video, let me know why and how I can make the next one a little bit more enlightening for you. I'd be happy to help. Thanks for sticking by until the end. Remember, take care of your families and take care of your friends. And you better make sure to take care of yourself. This very well may be the best time in the history of our lives to grow our wealth. Are you sitting on the sidelines, or are you going to be a doer? Are you going to go and take care of business? Are you going to be someone who takes action? And regardless of how your investments perform, there's always another day. So don't get too low, don't get too high, keep it calm, and keep it fi. See you next time.